Welcome to Learn Formula Education, where we simplify complex topics for professionals like you. Today, we're discussing notable developments in Canadian real estate for 2025, the legislative changes brought by Bill C-69. While these updates may not be revolutionary, they introduce important adjustments that every property owner and real estate professional should understand. We'll dive into how these changes impact property taxes, rental income, and real estate investments. Let's break down what you need to know. First, the Underused Housing Tax Act, or UHT. This legislation targets vacant residential properties to help address housing shortages, especially in urban centers where demand far outweighs supply. If you own residential property in Canada and aren't classified as an excluded owner, you're required to file a UHT return annually as of December 31. Bill C-69 updates the definition of excluded owner to include certain Canadian corporations, partners in Canadian partnerships, and trustees of specific Canadian trusts. This change reduces the need for unnecessary tax filings, making it simpler for property owners with Canadian ties to meet their obligations. It's a move designed to ease administrative burdens while ensuring foreign-owned vacant properties are properly taxed. Now, let's talk about penalties. Previously, if you missed the UHT filing deadline, you were looking at hefty fines, $5,000 for individuals and $10,000 for corporations. Bill C-69 significantly reduces these penalties to $1,000 for individuals and $2,000 for corporations. Additionally, transitional relief has been introduced, meaning that for the 2022 and 2023 tax years, if you submit your filings by April 30, 2024, you won't face any penalties or interest. This adjustment encourages compliance without imposing excessive financial burdens. If you're in the short-term rental game, think Airbnb or Vrbo, take note. Starting January 1, 2024, you can no longer claim tax deductions on rental income if 1. Your property is in an area where short-term rentals are banned, 2. You're operating without the necessary local licenses or permits. This change ensures tax benefits are only available to property owners who comply with local regulations. It aligns federal tax rules with municipal laws, reinforcing the importance of regulatory compliance. For first-time home buyers, there's positive news. The withdrawal limit under the Home Buyers Plan has increased from $35,000 to $60,000 for withdrawals made after April 16, 2024. This gives buyers more flexibility to access their RRSP savings for a down payment. Additionally, there's now a 3-year grace period before you need to start repayments, extending the repayment window to 15 years. This adjustment offers new homeowners more financial stability before repayment obligations begin. For real estate investors and developers, the purpose-built rental housing is an enhanced incentive. Under Bill C-69, eligible projects can now claim a 100% federal rebate on new residential rental properties, up from the previous 36%. This applies to projects started between September 13, 2023 and December 31, 2030, with completion required by December 31, 2035. Qualifying properties must meet specific criteria, such as having at least 4 private units or 10 private rooms. This initiative aims to stimulate the construction of new rental housing in response to Canada's growing housing demands. Changes to trust reporting are also noteworthy. All express trusts are non-resident trusts with year ends after December 30, 2023 must file a T3 trust income tax and information return, regardless of whether any tax is owed. However, Bare trusts, arrangements where the trustee has no significant powers or responsibilities beyond holding legal title, are exempt unless explicitly requested by the CRA. This adjustment enhances transparency in property ownership structures. So, what do these changes mean for real estate professionals, accountants, and investors? For accountants, staying updated on new reporting requirements is essential, particularly for clients with trusts or international property holdings. For real estate agents, a solid understanding of these tax changes will help you provide informed advice to your clients. For investors, the PBRH rebate and updated home buyers plan offer new opportunities for strategic investment planning. Navigating these updates requires proactive planning, even if they aren't disruptive. Start reviewing your strategies now to stay ahead. So, what do you think? While these tax changes aren't groundbreaking, they represent important updates that can affect your real estate strategies. Bill C-69 aims to improve compliance processes and create opportunities for property owners and investors. Have you encountered any of these changes yet? What questions do you have about how they might impact your real estate transactions? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful, be sure to like the video, subscribe to Learn Formula Education, and hit the notification bell so you don't miss out on new videos. Thanks for watching, and see you in the next video.